Hi there guys, and welcome to Renia Capital Advisors YouTube channel. We are going to be doing a series of videos on short-term trading patterns or short-term patterns, which I hope will help some of the traders out there understand shorter-term patterns and how they can be useful from an intraday or even a short-term trading perspective. To start off with, we are going to begin with an introductory session as to what shorter term trading patterns are about, and then later on we will be in follow-up videos moving on to looking at gaps, looking at volatility patterns, looking at candlestick patterns, and that type of stuff. Right now though, let's get our head around what short-term patterns are. Short-term patterns are bar charts or candlestick charts, basically, and we concentrate on the configuration and the characteristics of these individual bars, sometimes in relation to previous bars, and from there we are determining what the short-term patterns are. It is important to note that this is not limited to a particular period, so a short-term pattern does not perhaps occur within one day, but rather it is focused on a small number of bars. So these can be 2 daily bars, 2 hourly bars, or 2 5-minute bars as examples, but they are essentially a small number of bars is what short-term patterns refers to. Unlike longer-term patterns, which take very long to form, rising wedges, triangles, that type of stuff, short-term patterns are very common because they are they use much less variables to go into them, essentially just 4 data points, open, high, low, close, stretched over maybe a number of days, 1 or 2 days, or 1 or 2 bars or periods, and therefore there's lots of different combinations that you can have those variables in, and therefore they give lots of signals. So these signals are very common. We have to understand that because the signals are so common, they are less useful by themselves or in isolation. So they can lead to false signals at times, although it is interesting to note that most turning points in longer term trends have a valid short term pattern present at that turning point. Schwager in 1996, a respected technical analyst, said that short-term patterns successfully call 100 out of every 10 highs. So that just gives you some idea of how often, if we misinterpret them, they can give us false signals. So if you're trading short-term patterns, entry signals for these shorter term trades are usually closed either at the close of the same day, or at some point during the course of the same day, or at the opening of the next day, or at the first profitable opening that the market gives, or at the first profitable closing that the market gives, unless of course any time before that you are stopped out of the trade. It is useful for entering and exiting longer term positions at better prices. That's where short term patterns really help. They do, however, require a lot of time and effort to identify and find them, and therefore are sometimes not as suitable for market participants or traders who only have an hour or 2 to look at markets every day, but rather are more useful to traders who are able to watch the market during the course of the day, or at least for a number of hours every day, to take the time to find them, because they are sometimes a bit confusing and difficult to see. So in any case, the point of a short-term pattern is to anticipate sudden moves or large moves, similar to breakouts of larger patterns. The idea is to take advantage when prices are trading at emotional extremes, and then also to enter trends at advantageous prices on pullbacks or throwbacks. Just to give some context there, if a larger pattern breaks, like a ascending triangle or whatever the case is, these short-term patterns can be used to find those entry points a lot more accurately than what they would under normal circumstances. And also just to give the difference between a pullback and a throwback, both are essentially the same thing, but just in opposite directions. A throwback is when you have a bullish trend and then a bearish correction and then a continuation of the bullish trend. So for example, we have a rectangle formation, there is a break out of that rectangle formation. There's then a throwback to retest the what was resistance, now must be support, and then the continuation of that uptrend. That is a throwback. The opposite applies if it's a pullback. A pullback would have a bearish breakout of that same rectangular formation, then a pullback to retest what was support must now be resistance, and then a continuation of that bearish trend. So that's the difference between a pullback and a throwback. A pullback is in a downtrend, a throwback is in an uptrend. Both are just corrections and retests of the pattern that had just been broken. In any case, so what we have to do with short-term patterns is we have to look for a setup. So a setup is basically when known factors needed to establish a pattern are present. So the trader has to wait for the signal before a setup can be traded. So a setup is just basically a pattern, a price pattern, a short-term pattern, or a formation, or price formation. If a pattern, if the pattern rules are not all met, then the setup is not valid and we ignore it. If the pattern rules are all met and the pattern has formed correctly, we then have to wait for the signal before we can enter. Obviously, because we are trading shorter term time frames or shorter term patterns, time frame is irrelevant whether it's 5 minutes or 2 hours. The fact is we're using very few data points in order to find entries. We have to use tight stop losses and targets. It is also important that we must know the prevailing trend before the short-term pattern can be used. So for example, if we don't know the prevailing trend before we see a short-term pattern, and it might give a bullish signal or whatever the case is, we can't necessarily trade that because we don't know where it fits in with the bigger context of where we are in the trend. So for example, if we see topping patterns or reversal patterns, bearish reversal patterns, while the market is in a bearish trend, then these signals are meaningless and are to be ignored. If we see a bottoming pattern or a bullish reversal pattern while the market is in a bearish trend, this could be a potential signal for us to use and could have value. Obviously, the opposite applies in both cases. Short-term reversal patterns must only be considered when they occur near support and or resistance levels, significant trend lines, or significant moving averages. So what we are looking for essentially is we're looking for a number or more than one piece of evidence that shows us that a reversal is possible. So we're looking for resistance, we're looking for pattern breaks, we're looking for some sort of a momentum indicator, perhaps an oscillator, all giving us signals that a reversal is potentially on the cards. And in that case, we then say we have a cluster of evidence. So when we have a number of pieces all pointing towards the same thing, that is defined as a cluster of evidence. And these shorter term patterns are very useful when combined with a cluster of evidence or when found in a cluster of evidence. Then they have value. Otherwise, they tend to give false signals. So short-term patterns cannot be used in isolation, always in a cluster. So I've said this before, it is very important to remember. They can be used to determine that momentum is slowing down. So sometimes they can be an early warning system. Sometimes they can lead to a bit of a consolidation as well. So that is just a slowing down of momentum. Short-term patterns are usually reversal patterns, but can also be continuation patterns. And this is in the sense that, take for example, if the primary trend is up and there is a secondary trend that is down or a pullback, and then we see a cluster of evidence that we may see a bullish reversal and a continuation of that primary trend, and we see a short-term reversal pattern around that cluster. So it would be a reversal pattern for the secondary trend, but a continuation pattern for the primary trend, right? So we then use that as a continuation pattern on the primary trend so that we can get a good entry price into trading with that primary trend. So it could signal essentially when to take longer term trades with the primary trend. That is when they are used best. Again, within a cluster of signals. So they work best when they are at the peak or trough and they are present at a cluster, right? So at the peak or trough of a trend or a turning point in the market, potential turning point in the market, but when they are as part of a cluster. Otherwise, they are just, nice to know and not really very helpful. Short-term patterns are usually the first signals that a reversal is nearing or is possible. So for example, if you take a head and shoulders pattern, it takes very long to form, it takes very long to break out, but you could perhaps have at the very top of that head, in the head and shoulders pattern, you could have a short-term reversal, a short-term bearish reversal of sorts that consists of 3 or 4 bars or maybe 2 bars or whatever the case is. That could be your early warning that a potential longer-term reversal is on the cards. the more complex we make these patterns, and we can obviously, there's only 4 variables per bar, and you can combine a whole bunch of different bars together, so you can make them incredibly complex if you like. But you have to remember that if the more complex these signals or patterns become, the more or the less common they're going to be, the less frequently they're going to show up. Short-term patterns are essentially the relationship between the bars and not just the positions of the open, high, low, and close. It is a proportional relationship. This was sort of explored by a gentleman called Harris in 2000 in a paper that he published. And as an example of how this works, is the proportions between them is that if a close is in the upper 1/3 of the previous bar's range, then it can be used as a potential signal, or whatever the case is. So short-term patterns can also be split into 2 time periods. So basically what this means is you may see a short-term pattern that it's appeared now, and then you have a rule that says you have to wait a predetermined period of time before another pattern must appear, and then only do you have a signal. Or, for example, you could delay your entry by some predetermined period of time. After seeing a short-term reversal pattern, you see the short-term reversal pattern, you have a rule that says you have to wait 2 bars before you can take the entry. They are also capable of being interrelatable between different markets. So you could see a short-term reversal pattern on a commodity, which could give you a signal to take a trade in the equity market, or you could see a short-term pattern on a bond, which gives you a signal to take a trade on the forex market, or whatever the case is. They are interrelatable, so they're very versatile if we use them correctly. We can obviously use software to scan for these patterns. Great software to do this with is something like Metastock. Metastock 16 is a fantastic piece of software. It has wonderful scanning capability, but we have to be careful not to make them too complex. We have to keep it simple, because if we make these patterns very complex and we scan for complex patterns, we enter an endless pit of complexity. It's better to keep things relatively simple, so the patterns that we will be exploring in this video series will be the more sort of simple ones, easy to use, hopefully the ones that are the most useful, I think, for sort of more active traders. So there are 2 types of short-term patterns. One is the bar chart, the other is a candlestick chart. So one type of short-term pattern is made up of bar charts, or different bars, and the other one is basically candlestick charts. Both of these types of charts, bar charts and candlestick charts, use the same data, open, high, low, close, but they portray the data differently, obviously because the candles have real bodies and the bar charts don't. So they are very similar, but candlesticks are easier to see intraday price action. It's easier to see which way the pressure is pushing, so they are, I suppose, more popular in the market, and because they've got cool fancy names that are easy to remember. But it is important to remember that they are essentially very similar, and that no matter what we do, practice and experience is needed before we just start trading them. They are not simple, easy ways to make money very, very quickly. We need to understand that every single instrument is unique, and we have to find exactly which patterns work on which instruments, and how accurate they are at predicting potential moves. So keep a journal, track a number of ones, do a couple of paper trades with them at first, build up a sample size, see which patterns work best, which ones don't, before you start using them for real. So also, last couple of points, the data used for short-term patterns, regardless of whether it is a bar chart or a candlestick chart, is the open, high, low, close. So to go through these, the opening price is considered the price established from any news, emotions, anticipation, or mechanical signals from systems traders that have built up overnight. Generally, professional traders and scalpers and swing traders avoid opening prices and wait for some price action to take place, either a gap or opening range, before they get involved in the market. So be careful to act immediately when you see a gap in the morning or whatever the case is. Rather wait for a valid short-term pattern to form before before taking action. The closing price is the final price of the day, so professionals use these as a benchmark with which to compare the next day's price action, or they use the previous day's price closing price to compare as as a benchmark to compare today's price action, and also any future price action that might take place. Both long and short-term closing prices are generally the most important because people base their portfolio values and margining and all sorts of stuff on this, and it is considered as the most important price of the day because it consolidates and summarizes basically everything that's happened in that day. The high price is the upper extreme reached during the course of the day. This is measuring the buying ability or enthusiasm in the market for that particular security. The low price is obviously the opposite. This is the low extreme reached during the day. It measures the selling ability or the fear that was present in the market for that particular security. Configuration of the bar, so this is the length, position, preceding data leading up to the bar, previous bars, the price distance from the high to the low. These things are used to determine the short-term pattern, and those are the only things that are used to determine the short-term pattern. So the configuration of the bar and its relationship with the previous bar. Each of the above time frames, or each of the above, be it the prices, open, high, low, close, are applicable to either 1 day or 1 hour or 1 5-minute bar or whatever the case is. Each are applicable to just one data point. Well, one time period, whatever that time period might be. It doesn't really matter if that's 1 hour or 1 day. And very important to know that patterns are considered warnings and not signals unless they are part of a cluster of signals. So if you have a cluster of evidence, saying that there is a potential reversal on the cards and a short-term pattern emerges, that could be used as a signal. Alternatively, they are just nice to knows. So very important to remember that clusters, but that is probably the most important piece of this. Anyway, going forward, we are probably going to do a number more of these videos. Next up in this particular series focusing on short-term patterns is going to be looking at gaps, how to trade gaps, the different types of gaps that you get. So please stay tuned and come back and have a look at those when they are ready.